Hello, everybody. Good morning, good evening to wherever you are. Welcome to yet another session of Beyond Bulls and Beers, the weekly podcast by Team StaG to discuss the dynamics around the markets, the developments for the week, and what do we make out of it, and try and give a dope to our investors, to our audience, that what should they be expecting. This was an eventful week with ending with budget. Typically, we at Stack believe that budget is more of a directional intent of the government and nothing beyond that. And we call most of the budget as a non-event, but this budget was slightly important than the normal budget for a few reasons. One, this was the first full-fledged budget of Modi 3.0, and with all the dynamics of coalition settling down and state governments focusing on freebies again, it was important to understand what the central government wanted to make out of it. The second was important because over the last 2 quarters, we had seen a slowdown in government capex, urban consumption. There was so much talk around it. It was important to see how the government highlights and handles it. The third point is with the return of the Trump era, the talks of all tariffs and stuff, it was important to see how the Indian government handles that topic. I think overall, if you ask me, I think it was a very, very balanced, nice budget where all the key important points were addressed. And I will say, without much fanfare, more focus on what is doable and not doable. Let's cover the key factors in the parameters around the budget. The most important number, the fiscal deficit number, was pegged lower at 4.4%. Uh, while this number could have been slightly higher, the government went ahead with a lower number, implying that they want to signal to RBI that the rates are high and they want to bring it down, a signal to the RBI that please bring the rate down. We are ready to borrow less if required for it. The second signal was on the rating agency side globally. With the constant depreciation of the rupee, the government realizes the importance of rating agencies, especially with the inflation being high, and hence government wanted to have a better balance sheet. So that for me is a deep thinking in the right direction. The second point, the revenue estimates. I think broadly the revenue estimates looks good to me while the general comment is it's slightly aggressive. I think it's fine because the GST growth rate and the direct taxes growth rate is assumed to be slightly higher, and that has happened because the government is confident of bringing the growth back. These two line items clearly are dependent on how the income growth and the economic growth happens. What is also important is the capex. The capex number on a revised YoY basis is 10% higher, which which is looking higher, while on the old numbers it looks YoY flat, which means that government is expecting 25% lower 10% lower execution on the FY25 numbers. That is, it is for the first time that the government has actually lowered the execution plan when it comes to the capex, but that is expected because of the election, the extended monsoon, and the number looks more reasonable now. What it also implies is that this government is looking to more focus on executable number rather than anything. The third most important point for us was what happens to the populist measure, especially with Bihar election coming up and stuff. While there were more packages for Bihar again on the expected line, but it was not at the cost of fiscal deficit or planned expenditure. It was more about tweaking from one state to the other. So overall, I don't see huge populism there on that aspect. Now comes the most important aspect which all of us would have seen in the media, which is under the new tax regime, the government has given a tax-free slab of 12 lakh rupees. Now, this is a big boost. This is directionally a big boost because what it means is that the government recognizes a slowdown in the urban demand and is ready to tackle it. They are ready to tackle it by giving more disposable income in the hands of the individuals. What they have also done is they have tweaked a bit more in terms of the annual income from the rental and two properties and stuff, which means the higher urban class will have more disposable income and savings in the tax. We saw that it should bring the demand consumption in the urban back. We have been hearing about corporates talking about urban consumption being a challenge. Overall, what I see this is more income in the hand of the people, more execution in the hand of the corporates. There was not much of fanfare, there was nothing exciting about it. The government has deferred announcing the new income tax laws by a week. So this week becomes very important because the new direct tax code may get announced. We have the Delhi elections, and last night or early today morning, Trump announced the first leg of tariff news, where he has increased tariff from Mexico, Canada, and also China, while the rest of it remains the same. What it means is most of the major events are for this week are out of the market. Delhi elections, while from a Rajya Sabha mechanics, it is not a great one or an important one, but from an Indian political perspective, it's an important one because it's been nearly 10 years, or rather more than 10 years, since AAP has been ruling the state, and it's been more than 15 years since BJP has ruled Delhi, a state that has been eluding them. This election is important because AAP works on the dynamic of more populism in the hand of the lower middle class or the below poverty line people over growth. So it's a while BJP also has used the same formula of giving freebies, but if AAP does struggle in this elections, I have no views there by the way. But if AAP does struggle, it might help the economy perspective because it gives a view that beyond urban populism can't keep you in the power for long, and that is important for our economy to continue a healthy growth. That's much on the budget, that's much on the politics. Let's come back to what we are here for, the result season. This was a result heavy week with six of our portfolio companies reporting the numbers and many more outside that. We will limit our discussions to the portfolio stocks in the constraint of the time. Let's discuss the good ones first. Last Saturday, we saw what ICICI Bank did. ICICI Bank came out with I will say the healthiest result, and we discussed that in the last Sunday call. I That continued for us in form of Maruti reporting good set of numbers, and so did Chola. Both the companies showing a right mix of growth, margins being healthy, and we at least in our models we saw more certainty for the earning growth. What didn't work well for our portfolio companies, I think the biggest of all will be Tata Motors, followed by Ambuja. Let's discuss Tata Motors first because it's important to discuss what didn't work well. What worked well is always good. In Tata Motors, the management has already talked about struggles and had bring down their guidance, but they delivered even lower on that because China and Europe continues to struggle for JLR and hence margins have been lower. Please understand JLR is a huge operating leverage play, and hence a bit of tweak into that leads to further tweaking in the profitability and margins. We believe while the net debt and the FCF will remain positive, and then net debt increase will not be much, but the numbers may still take some time. But that is already reflected in the stock price. The stock is nearly down what 40% plus from the peak 6 months back. That's a huge correction. So don't see much downside from a valuation perspective in Tata Motors from the current levels, because the inherent India business is doing fine. The EV business is fine. There's no much issue about that. Uh, EVs. Maruti has launched its first EV, the EV Tara. The dynamics, the mechanics which they announced is similar to what it was they had guided for. And from whatever look and feel and the reviews we are getting from the auto experts, when I say the auto experts, I don't mean the auto analysts, but the auto industry experts, it seems that this car will be well accepted by the consumers. Coming to Ambuja results, Ambuja disappointed. If we take the one-offs out on the core operating basis, Ambuja disappointed. And the numbers, given the trend difference between Ambuja and the peers. Couple of notable reasons why that happened. The price hike which they took in December was not reflected in the numbers. Uh, the mix included volume more in south because of Penar and the other acquisitions they did last year, and those are getting sold at a lower price in south. There's a lot of ramp up happening in those acquisitions and few of the Ambuja plants, leading to higher cost, implying that the margins are lower. So a lower realization makes higher cost, led to a lower EBITDA. The important point to highlight here is they continue to get additional subsidy from the government for the good work they are doing, and stuff which will help their cash flows. So as a whole, numbers saw cut from the industry and growth estimates came down, but the management guided for coming quarters as the capacity utilization for Penar and other acquisition continues. Meanwhile, they have completed the acquisition of Orient Cement also. So the volume numbers will continue to increase. The EBITDA per ton may take couple of more quarters to improve, but broadly, again, a stock which is not participated in the rally, the valuation gap between Ultratech and Ambuja has increased fairly large, and Ambuja has been a gross underperformer to Ultratech. That's something we have taken notes, and we believe that Ambuja needs to get back on the growth for this to bridge. We are not changing our view on Ambuja at this point of time, and especially given the fact that the ramp up in the volume should happen in the coming quarters. The other result which deserves a mention is Chola. Chola came out with good numbers. The numbers were fine. After a slower growth in Q2, Q3 was good. There was a slight deterioration in the asset quality, but that is something which is fine because it's seasonally a quarter where agri loans saw higher NPA or delinquencies, and does a lot of financing around the rural economy. So that is something which was there. Coming to another financials, Bank of Baroda numbers. The numbers were not great, but numbers were not bad. Management continues to talk about moderate growth rate, though NIMS and asset quality surprised positively. NIMS again directionally was similar to what it is. Overall, what I believe is this stock will move from here on more from a market texture perspective. What I mean by a market texture perspective is that PSU banks, PSUs typically are high risk plays, and when the market texture is positive with more of HNIs and ultra HNIs and traders being active in the market, these stocks tend to outperform the broader market. That has not been there for last 6 months, and which is why we have seen a constant deterioration in the valuations for these stocks. Coming to the texture of the market, this week market was up roughly 1.2% for the week. Uh, it's a positive close, and it's a welcome positive close because the market has ended above the important 80 MA. That's an important number. We at our technical desk track, and we believe that if this week also can Nifty can manage to close above the 80 MA, we are probably out of the woods in terms of the constant deterioration we have been seeing for the last 3 months. Nifty also took important support at 12,500 and bounced back to close above 23,500. And I will be hoping to see 24,000 this week. And if we can end around that level by the time we speak next week, we are in good hands again. Uh, with the broader last month was bad for the market, with BSE 500 being down 4%, while Nifty was only down half a percent. Uh, if you look at the market dynamics post budget yesterday, there was a sharp money moving to consumptions because with the higher disposable income, it is expected to see up trading as consumers improve their spending in better quality brands, and hence the numbers and the margins for them. I think there's some overreaction there, and we'll wait for the market to settle down. In terms of our portfolio, we already have United Spirit, Jubilant, and Zomato taking care of it, and all the three participated well in the same. Nothing changes in our portfolio because of the budget. Nothing changes in our thoughts. It kind of validates our thinking that we should be back on the growth track soon. The market should do well, and we should be back to green days. It's been a tough 4 months for us and for our investors across the board. Not only our investors, actually broader equity market investors. Uh, that's the little from my side. I think broadly I'd have covered most of the point I wanted to discuss this week. I'll take a pause for 2 minutes. If there are any questions, we'll take care of it. As usual, you can drop a question to the in the chat or drop a WhatsApp to me. I'm on my mobile and I'll check it and respond here for you and the broader audience. With no questions, no messages, will not take more of your time on a Sunday morning. Have a good day. See you guys around. Thank you for your time.